Critical Mountain Pictures presents the Forex video training series, Greenbelt, Leading versus Lagging Indicators. In this lesson, you're going to streamline your use of indicators. You must fully understand not only how each indicator works, but how to correctly apply the indicator to make the best use of it. To do this, you must learn the strengths and weaknesses of each one. This is a concept to discuss before anything else. There are two types of indicators: leading indicators and lagging indicators. A leading indicator gives a signal before the new trend or reversal occurs. A lagging indicator gives a signal after the new trend has started. You're possibly thinking, I'll just use leading indicators all the time and I'll be ahead of everyone else every time. The issue with that is that sometimes leading indicators give false signals, which could lead to fake outs and you losing money. The other option, of course, is to use lagging indicators, which aren't as prone to bogus signals. Lagging indicators only give signals after the price chart is clearly forming a trend. The downside is that you'd be a little late in entering a position. Often the biggest gains in the trend occur in the first few bars, so by using a lagging indicator, you could possibly miss out on much of the profit. For the purpose of the lesson, we'll broadly categorize the technical indicators into one of two categories: leading indicators, or oscillators; lagging, trend following, or momentum indicators. Which of the two can be supportive of each other? They're more likely to conflict with each other. We're not saying that one or the other should be used exclusively, but you must understand the potential pitfalls of each. An oscillator is any object or data that moves back and forth between 2 points. Think of our technical indicators as being on or off. More specifically, an oscillator will signal buy or sell. The only exception being instances when the oscillator is not clearly at either end of the buy-sell range. The stochastic, parabolic SAR, and relative strength index are all oscillators. Each of these is designed to signal possible reversal, where the previous trend has run its course and price is ready to change directions. We've added all three oscillators to the pound-dollar daily chart. Notice when all three give the same signal. If you would have taken the trade in those instances, you would have made many pips. In the same chart, you can see sometimes oscillators give conflicting signals based on the candles. You can see that there are a lot of false signals. What happened to such a good set of indicators? The answer lies in the calculation of each one. The stochastic is based on the high to low range of the time period. In this case, it's hourly, yet doesn't account for changes from 1 hour to the next. The relative strength index uses the change from one closing price to the next. The parabolic SAR has its own unique calculations that can further cause conflict. That's the nature of oscillators. They assume that a particular price movement always results in the same reversal. We as traders know that's a load of shit. While being aware of why a leading indicator may be wrong, there's no way to avoid them. If you're getting mixed signals, you're better off doing nothing than taking a best guess. If a chart doesn't meet all your criteria, don't force a trade. Move on to the next chart that does meet your criteria and trade off that chart instead. Lagging indicators, or momentum indicators, help us spot a trend. The indicators that can do so have already been identified as the MACD and moving averages. These indicators will spot trends once they have been established, at the expense of a delayed entry to the trade. On the bright side, there's less of a chance of being wrong. On the pound-dollar chart, we've listed a 10 EMA, 20 EMA, and the MACD. Notice that when the 10 EMA crosses the 20 EMA, it signals entry to the trade. Similarly, the MACD also made an upward crossover and gave a buy signal. If you would have jumped into the trend, you'd have enjoyed a nice uptrend that followed. Later on, both indicators gave a couple of sell signals, and if you would have acted upon that, you'd seen dollar signs flashing in your eyes. Let's take a look at the crossover signals and giving them some false indicators. We call these fakeouts. Here's just a few pros and cons of indicators and oscillators. Each trader will have to make up their own mind, and once you're able to correctly identify the type of market you're trading in, you will know which indicators will give accurate signals and which ones are worthless at the time. This is no simple task, but your skill will grow with expertise, practice, and patience. In future section, we're going to teach you how to correctly identify the market environment you're trading in to better use these indicators.